I want you to think back to a moment. Maybe it was last month, maybe it was last week, where you looked at your bank account and thought, this isn't enough to do anything with. Maybe you had $100 left over after rent and groceries and the electricity bill, and part of you thought about investing it. And then another part of you, the louder, more convincing part, said, what's the point? $100 isn't going to change anything. So you didn't. And honestly, I get it. I really do. Because I've been in that exact headspace, and it's not laziness. It's a completely rational response to a world that constantly tells you that wealth is built by people who already have it. But here's what I've come to understand after years of thinking about money, studying behavior, and watching real people make real decisions with real consequences. That thought, that one quiet moment of what's the point, is probably costing you more than any bad investment ever could. My name is Finn. Welcome to Finley Invest. And today I want to walk you through what actually happens, mathematically, psychologically, and practically, when you invest $100 every single month. Not in a hype way, not with a clickbait promise, just honestly, because I think you deserve to see the full picture. Here's the thing about the way most people think about investing, and I mean most people, not just beginners. They think about it like a lump sum. Like you need a big moment, a windfall, a bonus, a tax return, to get started properly. And that framing is quietly destructive, because it turns investing into something you'll do eventually. When you earn more, when things settle down, when life is a little less expensive, which, spoiler, it rarely is. The second misconception, and this one's worth sitting with, is that $100 a month feels small because we're used to measuring wealth in big numbers. We see property prices in the hundreds of thousands. We hear about retirement savings needing to be seven figures. We read headlines about billionaires and portfolios that move millions in a single day. And so $100 feels almost embarrassing by comparison. But that comparison is the trap. You're not racing a billionaire. You're not competing with anyone. You're building something for yourself, on your own timeline, from where you actually are right now. And where you are right now, even if it's $100 a month, is further ahead than where you'd be if you waited. So let's talk about what actually happens. And I'm going to start with the math, but I promise I'm not going to make it feel like a maths class. If you invest $100 a month every month consistently into a diversified index fund that earns, let's say, an average of 7% annually, which is a conservative, historically reasonable assumption for a broad market index after adjusting for inflation after 10 years, you'd have somewhere around $17,000. Now, you contributed $12,000 of that yourself. The rest, roughly $5,000, showed up because of compounding. Because your money earned returns, and then those returns earned returns, and it just kept going. After 20 years, you're looking at around $52,000. You put in $24,000. The market gave you nearly $30,000 more. After 30 years, and I know that might feel like a long time, but stay with me, you're looking at around $120,000. From $100 a month, you contributed $36,000. The rest, over $80,000, came from compound growth. I want to pause on that for a second because I think it deserves some quiet. You didn't work overtime for that $80,000. You didn't hustle for it. You didn't sacrifice your well-being or your weekends. It came from time and consistency, two things that cost nothing except patience. This is what people mean when they talk about compound interest being powerful. It's not a gimmick. It's not a motivational poster. It's just arithmetic, playing out slowly over a long enough runway. Now, and this is important, I'm not telling you this to make you feel bad if you haven't started yet. I'm telling you this because the single most valuable resource in this equation isn't money. It's time. And the earlier you start, even small, even imperfect, the more of that resource you're preserving. There's a concept in behavioral economics called present bias. It's the very human tendency to overvalue what's in front of us right now and undervalue what's coming. It's why the $100 feels more useful today, for dinner out, for new shoes, for a weekend away, than it feels as a contribution to a version of yourself 20 years from now. Your brain is literally wired to discount the future. It's not a character flaw. It's biology. But once you understand that bias, once you can name it, you can work around it. You don't have to fight your psychology. You just have to build systems that make the future version of you a little harder to ignore. Let's also talk about what the market actually is, because I think a lot of people are intimidated by it unnecessarily. When you invest in a broad market index fund, something like a fund that tracks the ASX 200 or a global index, you're not picking individual stocks. You're not betting on one company. You're buying a tiny slice of hundreds of businesses at once. When the economy grows, your slice grows. It doesn't grow in a straight line. There will be down years, sometimes bad ones, but over long stretches of time, it has consistently grown. The people who get hurt in markets are usually the ones who panic during the bad years and sell. The people who do well are often the ones who do something almost boring. They just keep contributing month after month, including through the dips, and they let time do the work. Dollar cost averaging, which is really just a fancy term for what we're describing, investing a fixed amount regularly regardless of what the market is doing, actually works in your favor during downturns. When prices drop, your $100 buys more unit. When prices recover, those cheaper units are worth more. You don't need to time anything. You don't need to watch charts. You just need to show up. Here's where I want to shift the frame slightly, because the numbers matter, but they're not actually the most important part of this conversation. The real value of investing $100 a month, consistently, quietly, without drama, is what it does to your relationship with money. Most people live in a reactive financial state. Money comes in, money goes out, and whatever's left, if anything, just sits there until it disappears. There's no intention in that system. And without intention, money has a way of filling every available space with things that don't really matter. When you start investing, even a small amount, even a modest, humble $100, you're doing something psychologically significant. You're making a decision that your future self is worth planning for. That's not nothing. That's actually a profound shift in how you see yourself in relation to money. Over time, that identity starts to take hold. You start to think of yourself as someone who invests, and that identity influences other decisions. The way you think about spending, the way you evaluate purchases, the way you handle financial stress. It's not magic. It's just the quiet momentum of consistent behavior. There's also something worth saying about what $100 a month isn't. It isn't the sacrifice of your entire present. It isn't deprivation. It isn't refusing to live your life. It's one dinner out. It's a couple of streaming subscriptions. It's an amount that, for most people in a stable income situation, can be redirected without meaningfully changing their quality of life. And yet its impact, given time, is disproportionate to what it costs you now. That asymmetry, small sacrifice now, significant reward later, is at the heart of every good financial decision. It's not about how much you earn. It's about how deliberately you direct what you have. So if you're sitting with this and thinking, okay, where do I actually start? Let me give you something concrete and realistic. The first thing is to open a dedicated investment account if you don't already have one. In Australia, that might be a brokerage account through a platform like Perla or Stake, or through your existing bank's investment arm. Some people also look at adding to their super above the compulsory rate, which can have tax advantages worth exploring. This isn't financial advice, and what works best for your situation will depend on your circumstances. But the point is, pick a vehicle and open it. The second thing is to automate it. Set up a direct debit for the day after your pay arrives. Make it invisible. Make it something that happens without you having to make a decision each month, because decision fatigue is real, and the months where you're tired or stressed are exactly the months you'll talk yourself out of it if it requires a conscious choice. The third thing is to choose something simple: a broad market index fund. Something that tracks a wide basket of companies is a perfectly reasonable starting point for most people. You don't need to spend hours researching individual stocks. You don't need a complex strategy. Simple, diversified, and consistent beats clever and complicated almost every time. The fourth thing, and this one's about mindset, is to stop checking it constantly. Seriously, the market will go up and it will go down. If you're watching it daily, you're just giving yourself anxiety for no reason. Check in quarterly if you need to. Otherwise, let it be. The magic of this strategy is that it works best when you leave it alone. And the fifth thing? Be honest about what you can actually sustain. $100 a month is just a starting point. For some people, 50 is more realistic, and that's completely fine. For others, 200 is manageable. The number matters less than the consistency. A smaller amount invested every single month for 30 years will almost always outperform a larger amount invested sporadically and emotionally. I want to close with something I think about a lot, not just as someone who makes content about money, but as someone who's lived through the anxiety of not having enough and the slow, quiet relief of building something over time. We live in a world that's constantly rushing us. Faster results, bigger wins, instant everything. And personal finance has been infected by that same energy. The idea that if you're not aggressively optimizing every dollar, you're somehow failing. That if your strategy isn't sophisticated, it doesn't count. But the truth, as I've come to understand it, is almost the opposite. The most powerful financial decisions are usually the boring ones. The ones you make in an ordinary moment with an ordinary amount of money and then repeat, quietly, without fanfare, for years. $100 a month is not a small thing. It is, depending on where you are in life, a meaningful commitment to the person you're becoming. And that person, the one who shows up consistently, who resists the urgency of the present long enough to give the future a chance, that person ends up in a genuinely different place. Not because they were smarter, not because they earned more, but because they started, and they kept going. If you've been waiting for permission to start small, this is it. Start where you are, use what you have, and trust that time, given the chance, will do work you can't yet imagine. If this resonated with you, I'd love for you to stick around. There's a lot more on this channel about the psychology behind money, the way it shapes us, and the way we can learn to shape it back. Until next time, take care of yourself, and take care of your future self too.